We want to welcome everybody to the U.S. Kuwait Business Council's third major virtual event of 2020. Some of you may recall in April, we hosted Sheikh Mashal Al-Sabah of Kadipa for an update on Kuwait's efforts to mitigate the impacts of COVID-19. And just last month, we hosted both Ambassador Al-Sabah from here in Washington and Ambassador Romanowski for a council strategy session to outline some plans for the remainder of 2020 and into the new year. And today, I think we're very excited because we're again bringing really an all-star lineup of speakers and really look forward to what we believe will be a substantive conversation. For our webinar today, it's a collaboration between the U.S. Kuwait Business Council and the Kuwait Banking Association. And the speakers will in essence be providing an outlook, and we'll turn to them shortly. But I'm also very delighted that we're joined today by a very special guest, Mr. Farouk Bastaki, Managing Director, Group CEO, Chairman of the Executive Committee of the Board of the Kuwait Investment Authority. He's been kind enough to join and will shortly offer some opening comments. And before turning to our esteemed speakers, I just want to briefly share an overview of the U.S. Chamber and our U.S. Kuwait Business Council, as I know we're joined today by many who were engaging for the first time. The U.S. Chamber represents the interest of about 3 million companies of all sizes and sectors and locales across the United States. For more than 100 years, we've served as essentially the voice of business in the United States, where we engage Congress and the White House and that alphabet soup of regulatory agencies on those issues that impact companies' bottom line and their investment and commercial decisions. And that can range from taxes to the regulatory environment to trade, immigration, healthcare, and many, many more. And while we're most known for that domestic activity, in fact, our international division at the U.S. Chamber is the largest part of the U.S. Chamber, perhaps reflecting the outlook and interest and opportunities seen by American companies around the globe. And in the international division, we're actually home to more than 20 bilateral business councils. And I'm proud to say that the U.S. Kuwait Business Council is the newest member of our family. We were pleased that last October, we formally launched the U.S. Kuwait Business Council to provide a permanent platform to develop and grow our bilateral economic relationship and further cement our strategic ties. We were in fact joined by, I think, several of the banks that are joining today in that launch event. And I know Rick was with his CEO, Ron O'Hanley from State Street, our co-chair, to participate in that launch event. We've been working toward this goal of the council over the past 3 years and have really benefited from the strong support of both the U.S. and Kuwaiti governments. And during that time, we've established an annual U.S. Kuwait Economic Forum that's held on the sidelines of the government-to-government strategic dialogue. And I know Mr. Bastaki has been kind enough to participate in that on multiple occasions. We've had a CEO forum with His Highness the Emir in Washington, D.C. We've convened an event with U.S. Secretary of State Pompeo in Kuwait. We've brought a delegation of business leaders to Kuwait, in addition to a number of other high-level meetings in both countries, all to build a momentum toward that official establishment of the Bilateral Business Council, and ultimately to elevate and grow our bilateral economic relationship. And as we look ahead to the rest of 2020, we know that we're going to have a robust calendar, so please do stay tuned. Now, the council, of course, as the chamber, is only as strong as our members. And I'm really delighted that our co-chair, State Street, is playing a role in today's program. Our Kuwaiti co-chair, of course, is Faisal Al-Mutawa, and we thank him for his leadership. And we really want to thank our friends at the Kuwait Banking Association. Not only are they a member or a partner in today's webinar, but they're actually a founding member of the U.S. Kuwait Business Council, and we're grateful for that. As are several of the Kuwait banks. We have ABK is a member of the U.S. Kuwait Business Council, the Kuwait Finance House, and the Kuwait International Bank, all founding members of the council. So we thank you for your support. I do hope that provides some context for everyone, a little bit about both the U.S. Chamber and our Kuwait Council. I want to add a special thanks to Sheikha Aisa at KBA and Dr. Hamad for their leadership and their partnership and making today possible. And of course, my colleague, Sarah Carley, who joined just a couple weeks before we went into COVID mode. So I've spent most of my time getting to know Sarah virtually, but we're delighted that she's with us and really leading and taking on the responsibility of managing this new Kuwait Council. What we'd like to do now is turn to our partner for this event, the Vice Chairman of KBA. He's also Chairman of the Commercial Bank of Kuwait, Sheikh Ahmad Al-Sabah, for welcoming comments on behalf of KBA. And then we'll go to our friend, Mr. Farouk Bastaki, to offer a few comments, and then we'll go to our featured speakers. Sheikh Ahmad, please, the floor is yours.
Thank you. Thank you for having me on the US-Kuwaiti business panel. And I'd like to add that the business partnership between the US and Kuwait is an integral part of both countries' strategic outlooks and will continue going forward. The partnership has been built on the foundations laid down by Dr. Arthur Bennett, the first American doctor in Kuwait who took up residence in Kuwait in 1909 and established the American Hospital in Kuwait in 1913. With the agreement of Sheikh Mubarak, the Emir of Kuwait at the time, whose daughter, incidentally, was one of the first patients. And this partnership, built on the most noble of causes, has next big step in the post-World War II age, with a big push by the US to end colonization worldwide, which helped Kuwait achieve its independence in 1961. Another step on this path is the collapse of the Bretton Woods Agreement in 1971 and the pricing of a barrel of oil in US dollars without the convertibility to gold, which helped the US become the reserve currency of the world that we know today. This is not old, we know this. And a giant step in this partnership that will never be forgotten by Kuwaitis is the US-led liberation of Kuwait from Saddam Hussein's tyrannical invasion. And for that, I express our utmost thanks and eternal gratitude. Thank you, America. And I could keep listing steps, and there are many, but I'm afraid I will bore everyone listening in. Rest assured, there are many steps ahead, and we will continue climbing them together to new heights. Thank you.
Well, Sheikh Ahmad, thank you for those inspiring comments and reflection on the bilateral relationship. And again, let me underscore our appreciation to the Kuwait Banking Association for the partnership in today's event, and really everything that goes beyond that, and the active participation in the US Kuwait Business Council. We're grateful for that. With no further ado, we would love to turn to our friend, Mr. Farouk Bastaki, again from the KIA, and I know he's joined by several of his all-star team members, and Farouk, we're just grateful and honored to have you with us today. And please know we are grateful for all the support that you've provided as we've worked towards establishing the US Kuwait Business Council and all that you do for the bilateral relationship. So Mr. Farouk, we'll turn to you and look forward to hearing some opening comments from yourself. Thank you very much.
Well, thank you very much, Steve. Really appreciate it. It's an honor to be part of this event. And I would like to thank the US Chamber of Commerce, the US Kuwait Business Council, and the Banking Association, the Kuwait Banking Association, to provide this opportunity. For me to give few words about KIA and its relationship and its investment history in the US. Some of you have heard the story before. I'm just gonna bore you for 2-3 minutes about it. And, so I'm gonna give you a little bit of a background. Kuwait Investment Authority currently invests more than 50% of its portfolio, total portfolio, in the United States. And that's, believe me, it's a huge amount of money. This started in 1953, which is 67 years ago. It's a long time, and it started by opening an account, I think, in Citibank, and we still have that account. So it goes back a long time. KIA, just for the participant who doesn't know what we do in the US or what we do exactly as Kuwait Investment Authority, we invest in equity, in fixed income, in alternative investment. Equity, we are in large cap, small cap, medium companies, different strategies, passive, active, or even direct, holding direct shares in certain companies. In the fixed income, we do also the whole thing, T-bills, T-bonds, corporate bonds, TIPS, and so on. Alternative, we started in early 80s, which is, very long time for the alternative. I think it started in like 84 or something. And we do private equity, we do real estate, infrastructure, and hedge funds. These investments basically are done mostly through external fund managers, especially when we talk about investment in the listed equity. It's done through external fund managers, people like the BlackRock, Goldman Sachs, JP Morgan, PIMCO, and others. The alternative also done with very well-known managers, mostly US managers, such as Blackstone, Carlyle, KKR, TPG, and many, many others we've been having this relationship with them for a very, very long time. Also, we invest in large US companies, directly or through portfolios, such as Apple, Microsoft, Google, Amazon. We have a big chunk of Visa, BlackRock. So these are direct investments that we keep in for a while, and it's done very, very well for us. Bank of America, of course, we are also a large investor there. Kuwait invested in real estate through a 100% company called Foster Lane, which is it's based in Atlanta, Georgia. And what these people do, they invest in core real estate, core buildings and core real estate, especially the office side in the United States. We have buildings in New York and Washington, D.C., and many other cities. We participated in some development projects in the United States. We were one of the earliest investors in Hudson Yard, which is the largest private development project in the U.S. history. When I say early meaning, we were the first one actually with a related company. We are partnering with Related, and we did that. And now I think it's one of the best projects in New York, and it's very well. It has very, it's very well known. This is just a little bit of background about KIA, and I started my introduced by saying the introduction by saying that we've been in the U.S. for 67 years. The last 20 years, for example, we increased the amount of money invested in the U.S. by 21 times. So whatever that number was 20 years ago, it's now 21 times X, which is, we hope to keep that track record, but it's going to be a little bit difficult, but we will do our best. Finally, in conclusion, I would say that Kuwait had a very great and long-standing relationship with the United States, and we appreciate the U.S. support in all kinds of different issues that, in all aspects that we have support of the United States. And of course, we will never forget the U.S. role in liberation of Kuwait in 1991, and thank you all very much for that. Thank you.
Well, Mr. Farouk, thank you for that overview of KIA and in particular the relationship, the longstanding relationship that you've had with the United States. You're clearly an important driver in that bilateral economic relationship, and being the world's largest, or being the world's oldest sovereign wealth fund, there's a lot to learn from you, and we appreciate the top flight operation that you run and the great team that you have. So thank you for sharing those observations and reflections. We very much appreciate that. And we're delighted to have you with us today. Next up in our lineup, I'm going to turn to a U.S. Chamber colleague, our senior economist, who oversees the analysis of the U.S. and global economics he actually joined the chamber just in January of this year. So I don't know, Curtis, if you knew what you were getting into when you came to the chamber, but you've obviously had to hit the ground running. Among Curtis's duties are that he works to advance the U.S. Chamber's indices and other economic analytical products that tell compelling stories about how our economy is responding to policy shifts, business trends, geopolitical factors, and obviously unknowns, occurrences like COVID-19. For the last 3 years, Curtis served as the senior economist at the American Bankers Association. He previously was a research fellow on tax and economic policy at the Heritage Foundation, covering implications of policy on the United States economy. He's testified many times before Congress and is regularly cited in national news outlets. I also should share that early in his career, Curtis worked in transfer pricing at PwC in Atlanta, and he's also served as a senior economist at the Tax Foundation. He holds an MA in economics from the University of Connecticut, a BA in economics from the University of Richmond. Curtis, we really appreciate you taking time out, and we really look forward to hearing your forecast and thoughts on the U.S. economy. So with that, we'll turn it to you.
Thanks, Steve. Really excited to be here. I'm going to walk through where the economy is right now and where it may be going, and hitting on all the various data points that we follow to try to get a hold on what is going on in the economy. I'm going to go ahead and share my screen so you can see the slides that I prepared. And hopefully you can see that now.
We can.
There we go. Okay, great. So one of the initial fallout from COVID-19, we saw a really big spike in unemployment here in the U.S. And one of the ways, the easiest, the most up-to-date way to follow that was unemployment claims. These are initial claims in unemployment. Prior to COVID-19, prior to March of this year, the record high claims for unemployment insurance in 1 month was back in October of 1982. And that was 695,000 Americans filed back then. In the first couple weeks of March, we're talking 200,000. So we were well below that. That's kind of average for the US, about 200, mid 200,000 people filing for unemployment. That jumped up in the third week of March to 3.3 million. The following week, March 28th, it jumped almost to 6.9 million. 6.9 million Americans filed for unemployment all in just 1 week. So 10 times the record, the previous record. It has, the good news is it's been following ever since then. I think it's 16 weeks now that we've seen declining unemployment claims. However, unfortunately, you can see we're still above 1.3 million initial claims a week. So still a lot of people filing for unemployment. Now the data is hard to collect. It's done by a state-by-state basis here in the US. And there's some definitional issues and there's some backlogs. So we don't know how accurate this number is, but we do know that it's still highly elevated. Of course, we've had some reopening that's probably slowing now. So we want to also look at not only initial claims, but continuing claims. Continuing claims would account for those who have initially filed, minus those who aren't claiming anymore, presumably because they've gone back to work. And that has been coming down steadily since the middle of May. So that's really good news. We peaked at something around 22 million continuing claims. A 4-week average is usually how it's looked at. And now it's down to about 19 million. So still very, very elevated, very high, but it does seem to be declining. Now, with everything I say, keep in mind that all these data points come from before the recent spike in cases here, COVID-19 cases here in the US. We are likely to see some pullback in all the economic data that we hit on today. And the general theme of what the data will show is that we had a severe contraction that is on par with the Great Depression and the Great Recession from 2007 to 2009. It's not hyperbolic to compare what has happened in the US economy to the Great Depression, but we've had some bounce back. We bottomed out in April and May, and we bounced back in June. Again, though, that was before the recent spike in cases. So we're likely to see some tempering of the economic data as we go forward. Our jobs report has been very good in both May and June. We've added back, there was 4.8 million jobs in June, 2.5 million or so jobs in May. So that's good. We've added about 7.5 million jobs. but we lost over 20 million from February, which was the peak. So there's still a long way to go. There's still 17 something million jobs to fill. 14.6 million jobs to fill to get back to where we were in February. That's going to take a long time. We are not going to get back to those levels in the near term. The unemployment rate has come down. We peaked at about 15% and it's now just below 12. But there's still a lot of work and a long way to go to get back to the levels of employment we had prior to the crisis. Prior to the crisis, the economy was growing pretty well. We were growing about 2% through 2019, and that was the case into the middle of March. Actually, this is how the economy was tracking, about 2% growth. We had a little bit of headwinds from both the COVID-19 crisis started as a supply side shock here in the US. We were having a hard time getting supplies from China, and that was contributing to a slowdown of growth in the first quarter. And so was the Boeing shutdown of production in the 737 MAX. So maybe we would have come in below 2% had we not had the enormous shock from COVID-19, but it did hit, and we had growth at -5% in the first quarter. And that's sometimes it's a little confusing how that's presented. That is what's known as an annualized number, which means that the economy would have to contract by that much for 4 consecutive quarters. So you get a -5% growth over a year. What it really means is you can divide that by 4. So the economy fell by 1.25% from the fourth quarter of 2019 to the first quarter of 2020. And that matters because of this next chart. These are what the various forecasters we follow are forecasting for the contraction of growth in the second quarter to be. We're talking anywhere from basically -30% to over -43%. So when I say it's not hyperbolic to compare this to the Great Recession, this is what I mean. We're going to see record high contraction in or I guess you say record low contraction for the second quarter. And these again are annualized numbers. So you divide those by 4. So the average is something like 34%. So you divide that by 4. So you're looking at a 9% contraction in growth from the first quarter to the second quarter. And that's on top of the 1.25% contraction in the first quarter. So over a 10% contraction from the end of 2019 to the end of the second quarter. Very, very steep. And it will dig us a very big hole, which I'll show you in a second. So the question is now, we're likely past that steep contraction. You can see how deep it goes on a quarter-by-quarter basis here. We should get a very strong rebound. It will, on average, the same forecasters are looking at about 23% growth in the third quarter and then 9% growth in the fourth quarter. But the contraction is so steep in the first and second quarter, you still get an annualized number that is negative for 2020. But then you get continued growth into 2021 of 4.5%, which is stronger than it would have been tracking and which you'd expect. This is all the idea that sorry, I lost my train of thought. The letter shape of the recovery. That's what I was gonna get at. A lot of talks about, are we gonna have a V-shaped recovery, a U-shaped recovery? It's a little bit up in the air now. I would have said we were probably on track for a pretty strong recovery, which would get somewhat V-shaped, but very sharp contraction, a very steep recovery. But the recent uptick in cases really throws that into question. That said, we're going to have very strong growth numbers for the next couple of quarters. I would anticipate, which is important to point out that there's going to be a clear distinction between growth rates and levels, which this next chart will show. So we're going to have really strong growth rates of all sorts of things: GDP, jobs, all other measures that I'll go through in a second. The thing is, we're going to be below the levels we were at before COVID-19 hit for a while. And that's what this chart shows. So even with those pretty robust growth numbers that I just walked through, it takes us to the middle of 2021 just to get back to the level of GDP we had before COVID-19 hit. Now, if I had done this chart a couple weeks ago, that was pushed out to the middle of 2022 because the growth numbers, the contraction numbers for the second quarter were steeper, and the growth number and that made it a longer recovery period. Those forecasters have cut back on that contraction number a bit, and that has increased or accelerated the recovery. This could move again. So if I did this in a couple of weeks and we get some data for the recent shutdowns, this could get pushed out to the end of 2021 or 2022. So a long way to go till we get full recovery because of the steepness. Look how steep that drop off is from 2019 Q4 down to Q2 2020. You're talking over $1 trillion lost of economic value. Big hole to fill. It takes a long time to fill it up. This is an index that we follow. It's called the Weekly Economic Index. It uses 10 real-time measures, things like unemployment claims that we talked about, staffing, agency levels, real same-store sales, gas sales, steel production, energy production. This is interesting because it shows just how steep the economy dropped off and how quickly it dropped off, and how it's slowly recovering. We're getting close. We're going in the right direction, although progress is slow. For scale, we are a lot steeper than we are, a lot lower than we ever were during the Great Recession and the financial crisis. So this has been a very, very severe recession. One of the things that will lead us out of the recession, of course, is consumer sentiment. Like how confident are consumers? The better they feel about the economy, the more they're likely to spend. They're doing better. Their sentiment and their confidence has improved. It bottomed out in April, and it has improved steadily in May and June. Hopefully, we'll get numbers for July in a couple weeks or in a couple days, and hopefully we'll see continued improvement there. One thing that is important to look at for this is the future expectations, because if you feel strongly about the future of the economy, you're much more likely to buy big ticket durable items like cars, appliances, and homes, and future expectations have been ticking up as well. Again, back to this rates versus levels issue, the rate of improvement is good, but we're still well below we were just back in February. So a ways to go for full recovery. And again, these are from before the recent uptick in cases. Consumer confidence has jumped more than sentiment. They're roughly the same type of measures. There's just two different surveys that look at this. But again, strong recovery in June. We'll see what happens in July. My guess is that it will be an improvement, but the improvement will be a lot less sharp than it was back in June. Interesting enough, we've had a big boost in personal income here in the US, and this comes because of the response from the government. The government has boosted incomes in two ways. One, they provided pretty generous payments to individuals and families, $1,200 per person, and then $500 per child. So a family of four could get a pretty big check. They phase out for income, but that had helped boost incomes in the short term. And then unemployment insurance has been plussed up. You get an extra $600 a week if you're on unemployment, above your traditional unemployment payments. So that boosted incomes in April by 11%. Now they fell again in May because those payments started to tail off, but they're still, you can see, look at May 20 there, income's still significantly higher than it was in February. So this is really boosting income. So there's a lot of money out there. The difficult thing here is these things, the payments are about done to families, and the unemployment insurance benefits, they stop at the end of this month, the extra $600. So this is going to come way down in August unless Congress does something in the interim. And so there's going to be a big push at the end of the month here to do what's called a phase 4 bill to somehow keep the unemployment benefits and maybe some other type of payments going so we don't see a big drop off in incomes. Of course, it's harder to spend when you're locked down or you're not going out because of fear of the virus. So a lot of this money people have it in their savings and their checking accounts, so they will spend it eventually. But that drop off in income is going to be a big sticking point here in the U.S. in the coming weeks. I'll flip through these things quickly now so I can hand it over to Rick. Prior to the COVID-19, wages were growing very strongly here in the U.S. and they were actually outpacing inflation pretty strongly. So real wages were growing. That was really good. The unfortunate thing of the fallout COVID-19 in the labor market and wages is that wages were growing the strongest for those at the bottom of the income scale with the fewest skills. It took us 10 years of churning through the labor market to get to that point where those incomes were growing fastest. All that progress has been undone because of COVID-19. Those at the lower end of the income scale with the fewest skills have seen their jobs go away at a higher rate, and it will take a long time to get them back to work, and it'll take a long time to getting them back to the income growth that they were experiencing just a couple months ago. So retail sales have been improving. That's good. We know that's gonna be as the economy unlocks and people go back to closer to normal, that they'll be spending more. Interestingly, in-store retail sales are still 82% of all sales here in the U.S. You wouldn't think that. You think most people still shop online or move to shopping online. There's been a big growth, which I'll show you in the next chart, but still, the vast majority of sales happen inside traditional brick and mortar stores, and that has not changed materially in the last couple of months, although it did spike. So you see a huge spike in April and May, but there was a long-term trend. The long-term trend was moving to online. You get this enormous spike in April and May, or actually March and April, and then it comes back down in May. So this would be really interesting for things like commercial real estate and just retail in general, is what happens in the coming months? Does that percentage come back down and return to trend? Is there a permanent shift up, and how big is that shift? My guess is that we come back towards trend a good deal, but that there's somewhat of a permanent shift to shopping online compared to in-store sales. And again, that has a big impact on commercial real estate, the banking industry, and there could be some long-term implications there. Real good on the business side. Business confidence is rebounding in the U.S., slightly more than in the U.S. That's good news. Again, this is prior to the uptick in cases. To caveat that all the time. So businesses are getting more confident. Let's see if I can find here we go. This is small businesses here in the U.S. This is the National Federation of Independent Businesses, their monthly survey of small businesses. Really strong growth in June. This came out yesterday. So this is really good news that small businesses are feeling better. Most of the components of this index increased sharply for the month. So that was good news as well. And I'll wrap up. Manufacturing is doing well, as are non-manufacturing services. So business side is looking better, and housing has rebounded pretty strongly in May. We're starting to get June numbers now. This is one area that could really help push the economy out of recession and help strengthen the recovery. And for two big reasons. One is the COVID-19 hit during the spring buying season. A lot of Americans buy housing in the spring season. That was delayed. They couldn't buy houses at the same level, although the people were still buying houses, but not at the level they would have. And then we're going to have low interest rates for the foreseeable future on mortgages. So we are anticipating a pretty strong housing market in the coming months. But I just want to get quickly to issues with our Federal Reserve, and I'll close on this. The Federal Reserve has been very active in its response to COVID-19. Its balance sheet has more than doubled. This chart is a little out of date. The balance sheet is now over $7 trillion. And one of the governors, Lyle Brainerd, yesterday said that they're going to have to continue this response. So look for continued growth in the Fed's balance sheet. We have no idea what that's going to be. I don't think they know. They're going to keep on doing what they're doing, providing liquidity through the various facilities they set up. For the most part, though, the growth of the Fed's balance sheet isn't necessarily those facilities that they set up for direct lending to businesses, to municipalities, into the repo facilities. That's kind of the orangish color. The run up is the traditional Fed buying of mortgage-backed securities and U.S. Treasuries. That's where the majority of growth is coming from. So the currency swaps, which is kind of the purplish grayish color, that is certainly a part of it as well, but it's small compared to the Fed directly buying those mortgage-backed securities and treasuries and adding them to their balance sheets. Of course, where's all that liquidity going? It's going into reserves on banks' balance sheets. So this may cause a problem in the future. I'm not sure the Fed cares right now, or I share their view that inflation is a problem for tomorrow, and tomorrow could be 5-10 years from now. The big problem right now is making sure that you keep functioning credit markets, keep financial markets liquid, and we don't have deflation, which is what we had. We had inflation measures falling for the last few months, but that has steadied somewhat. So if the Fed is fighting the problem in front of it right now and not worrying too much about in the future, and I think that's probably the right approach. With that, I'm going to stop. I could go on all day with all the different things going on. It's a very interesting time, but I don't want to cut into Rick's time. Happy to answer any questions you have when we get there. Thank you, and I'll hand it over to Rick.
Thank you so much, Curtis, for such an insightful presentation. And we really appreciate you being here with us today. Switching gears slightly to focus more on the banking sector, I have the pleasure of introducing our next guest. As Steve mentioned earlier, Rick also joined us at the launch of the U.S. Kuwait Business Council last year. So thank you so much. It's wonderful to have you back. And we're really excited that you could join us today. Rick is joining us from our council co-chair, State Street, where he is the Executive Vice President and Chief Global Chief Investment Officer for State Street Global Advisors. He's responsible for all investment management activities, including research and trading. He is also a member of the firm's executive management group. Prior to his role, Rick was the head of Global Active Equities and previously the European Chief Investment Officer. He's held a variety of positions in quantitative fund management and research, including as the head of quantitative research and head of structured equities at Gartmore Investment Management. He has a bachelor's in science from Lancaster University and a master's of science from London Guildhall University. He's a regular writer and broadcaster on investment issues and speaks frequently at industry events. So very perfectly poised to speak to us today. Welcome again, and we look forward to hearing your perspectives.
Thank you very much. And thanks, that was a great setup as well from Curtis. So thanks for that. So let me see if I can get my working with the keynote. Is that visible?
Not yet. If you look at the bottom, there's a share screen button. It should be green right in the middle.
That's the one I hit. Yeah, I've got shared screen, but that's the one. I found it. Thank you for the help.
Perfect.
So I'm going to talk about global trends in banking. It's actually been really interesting putting this presentation together. Those who know me know that I have a great interest in financial market history, but we're actually supposed to be looking forwards, not backwards. But if you'll indulge me, I'll look a little bit backwards at first and then look at what's happening post-COVID-19. And maybe more importantly, what's happening to the business model of banks globally, which is changing really significantly. And it's a change that's probably been accelerated by the events of the last several months. If you look at the timeline of bank history, we go back appropriately to the Babylonian idea of banks and everything in between. I think no one can claim to have invented banking, but we all know that it has, in a sense, a very simple model. Certainly fractional banking has a pretty simple model, but it has spawned many different subcomponents over the years. But if you look back in the more recent past of what's happened before the global financial crisis, we've had this very long-term trend of reducing interest rates. This goes back about 8 centuries, but people talk about lower for longer. That's been going on for quite a long time. Obviously, if you go back to the 18th century, you had sovereign defaults because the sovereign needed money for a war. He'd raise money from rich people, wouldn't always pay it back, or maybe there was a problem. But what you found is that sovereign default risk has gradually declined over time, certainly in terms of repaying in your own currency. And that's changed the nature of banking. At the moment, we are in a kind of lower for longer environment looking forward. And how's that changed things? It's reduced quite substantially the amount of leverage in the system after the global financial crisis. And it's, at a consequence, reduced the return on equity of banks. So I think if you look back to what many nostalgically view as the golden era, where returns on equity would be in the teens, that was only really achieved through quite high levels of leverage. And after the global financial crisis, leverage came down quite a lot. So not surprisingly, even though return on assets remain reasonably high, which is the line there that you can see there, the return on equity, which is what happens after you've adjusted for leverage, came down. It's actually been a little bit more buoyant in the last several quarters before the crisis, but it's certainly been low. So this is a chart that's saying banks in the US have become somewhat less risky because they've been forced to delever quite substantially. So that's thrown an emphasis onto the business model, the operating costs, and a whole lot of other things that have been, I think, a big challenge for those running banks. But if I just turn to the more recent past and the COVID-19 crisis, Curtis did a great job of sort of explaining what had happened. And for me, these two charts characterize the difference between the global financial crisis, which is the bottom chart, and the top chart, which is the COVID-19 crisis. So the boxes that you can see there, each of them represent one of the actions that was taken by central banks or other authorities during the first financial crisis. And it took a really long time for things to get straightened out. And there was a lot of concern about moral hazard. All of those concerns appeared to go out of the window completely in this particular crisis. And the dates have gone a little bit funny, apologies for that. But you'll be aware that during this crisis, in a matter of days and weeks, you had very substantial action taken by central banks. And we were actually at the heart of that. In fact, it was very gratifying that we were invited by a number of the central banks and policymakers to comment on what was needed to get the financial system working again. And there was no question of resistance. They were welcoming that input and actually implementing the input very rapidly. And as Curtis pointed out, an enormous ramp up in central bank reserves as a consequence of that. And we don't begrudge that. We think it's been incredibly helpful. But if you look forward and you think, right, well, what are the drivers from now on? I said at the beginning, that banks are a pretty simple business in a way. You've got the volume, which is how much your balance sheet expands or contracts. And then you've got the spread between what you're lending at and what you're taking in and paying for deposits. And ultimately, your top line is determined by those. That's in essential revenue. Your bottom line is determined by non-performing loans, provisions, and importantly, operating costs. Now, we know that banks are more complicated than this simplified model, but it's pretty important to understand that when you think what's going on during the crisis. Asset growth is happening because companies are taking out standby loans, or they're actually borrowing a lot more. Consumers are borrowing less. Trading revenue, as we saw from results yesterday, has been very strong for a number of the largest banks, both in Q1 and Q2. And net interest margin is the problem area, because the impact of quantitative easing, both the flattening of the yield curve and the absolute fall in yields, has been a pretty big problem, not just for the short term, but for the long term, as we've seen in Europe in particular. And the cost base at the moment is going sideways. Now, I think there is an enormous amount of optimism about cost base in financial institutions going down and productivity going up. And I'm going to talk about that in the second part of the presentation. But what we also know is that provisions have started to appear. And just in the last several days, we saw some cautious statements from banks about the way in which they're thinking about provisioning. So where has that left banks with investors? In the short term, I think if you look at this survey from the Bank of America, and we look at our own data at State Street, our custody data, really telling us the same thing. Banks are not super popular at the moment. People look at banks and they're a little bit cautious both about the spread, the net interest margin. They're cautious about the provisions that need to be made in the future. They're actually a little bit cautious about disruption as well. The good thing is that banks are now perceived a little bit more as part of the solution to the COVID-19 pandemic, and the fact that they're, together with governments, assisting in economies staying alive. But that's not been terribly popular with investors in some respects, and they've become more underweight in banks relative to the rest of the universe of investments. So what's happening with provisions is that they're going up pretty rapidly. And as we know, US has always been ahead of the curve in the sense that US philosophically tends to recognize losses much more quickly than the rest of the world. Obviously, there's regulatory issues that have affected that as well. But the fact that the US is also a large consumer economy has quite a large impact on the provisions and non-performing loans as well, because there's an expectation that that unemployment will bring with it a bit more stress to the consumer, even though at the moment household balance sheets are in quite good shape. In the future quarters, that may not be the case quite so much. There has been enormous help from governments, and there's a lot of programs around the world where the government takes a first loss position. So as corporations are being propped up in a sense by a combination of governments and the banks, not all of the losses will fall on the banks. And so it's a little bit confusing to pick apart what the eventual losses might be for the banks. And I think there's also this emerging dividing line between the US, Europe, and other parts of the world, where I think the US has certainly got a more immediate way of recognizing problems than Europe. And if I were to put it, not very politely, the Europe and some other countries follow the pretend and extend sort of model of the world, where they try and keep the show on the road a little bit further along. What does that leave us with things like capital ratios, though? Capital ratios have been recovering incredibly strongly. And in fact, as part of the research, I was looking at banks in Kuwait, and their reserves have been incredibly strong in the lead up to the crisis. But if you look at Europe or US, there's been a very, very strong recovery in capital ratios. The question has been, can buybacks continue? And I think there's been, appropriately a pause on buybacks in many cases. I think dividends can and should continue in banks by and large. Investors need them. And I think they have a relatively small impact on capital ratios. Europe is a lot more hawkish than the US. I think the European Central Bank, the Bank of England, other central banks have been a little bit more cautious about dividends than they have been in the US. But if you look at the longer term trends in global banking, the real imperative is to reduce operating costs. There's not much you can do in a sense about net interest margin. You can take more risk if you like. You can look for more opportunities to get deposits in at a low price. But it's really the operating costs that matter. And I think particularly because quantitative easing reduces potential income, there's been enormous pressure on it. So what does that mean? Often branch reductions. And the chart here shows the US, the number of branches that banks there are in the US. So I found it a little bit surprising that even after the global financial crisis, they're actually increasing the number of branches rather than decreasing. But you'll see in common with the rest of the world, that's now rolling over pretty substantially. And in some countries, they've halved the number of branches in the last decade. It leads us on to the sort of question of how is that going to happen? You can't just shut branches, but clearly the events of COVID-19 have encouraged many more customers to conduct their business, not just transactional, but wealth management business by virtual means. And what's called the Scandi model, the Scandinavian model, is one in which banks have often got a cost to income ratio of 30 to 40%. That's enormously different to the rest of the world, where it's still often stubbornly stuck in the 60s. It's not easy to go from A to B. Clearly, mergers and acquisitions are part of the equation here. And I think in areas of the world where you've got enormous numbers of competitors, there is the potential to reduce the number of banks and thereby accelerate this process of branch closures and digitization. But digital, as I'll come onto, is a double-edged sword because it enables these disruptive businesses to come into what has been, in some countries, a more cozy business. So challenger banks can come from a number of places. You can challenge yourself. You can have a pure play that's a new business like a Monzo or Revolut or many of those other startup businesses. Or you can have digital affiliates like Ant Financial in China and many of the others that have kind of affiliations with some of those technology companies. They offer lower operating costs. They don't start with a legacy platform. They're typically more customer friendly, particularly on things like KYC. And I think what the analysts that I've studied look at is that there is a threat to revenue, whether it's remittance revenue, transaction revenue, processing revenue, and the core business of saving and lending. But the cost savings are much bigger. So in a sense, disruption is a bad news story, but it really is disguised as a good news story. As a global investor in banks, this is actually light at the end of the tunnel to improve the business model. The other point worth noting is that the disruption, in a sense, is a bank issue, but it's also an issue of dealing with the unbanked. There are estimated to be 1.7 billion people unbanked. And we know there's been a lot of progress, particularly in Africa, in mobile banking with M-Pesa, but also Ant Financial, which is very active in many countries around the world. I've seen estimates that 700 to 800 million customers will be now banked by the end of 2022. And the reason for that is there's a lot of enabling technology. There's enabling technology like ID. So if you can identify through biometrics the population, it's much easier to go digital and to have things like mobile banking. But there is a tension here. And whenever you have this sort of disruption discussion, I think regulators get a little nervous, and it's right to get nervous. It's a highly regulated activity. It's at the heart of financial stability and consumer protection. And so you need to balance pretty carefully the speed at which you're going to have that disruption. The other disruption, which is important to note, which is a neutral, but it could be a negative, is digital currency. I think Libra, my personal view is that Libra was a fantastic innovation, maybe carried out by the wrong party because Facebook had this kind of haze over it that was unfavorable. And I think there was a lack of trust as a consequence. But the basic idea of Libra, it's a little bit like an ETF in some respects, but it's a fully backed, tethered currency, multi-currency that would really potentially reduce transaction costs very substantially. Clearly, if it became a currency of its own that was fractional, there's control issues and financial stability issues. But I think what it gave rise to was a lot of new thinking about digital central bank currencies. And I think, again, these would be very welcome, provided they didn't cause a run on deposits in banks. Because if consumers can have digital currency, why would they want currency in the bank, particularly when interest rates are virtually zero? I think deglobalization is worth more than a passing mention, because a lot of the deglobalization is to do with tariffs, but behind the scenes, there's a risk of financial deglobalization. And again, it's a threat to the profit pools of global financial institutions that's pretty substantial. And also the weaponizing of financial institutions through the use of sanctions. I think it's not just about China, US, but certainly that's in the headlines because of the risks that we run when we're investing everywhere, as our friends in Kuwait are. We're investing everywhere for clients in different parts of the world. We're investing in global banks, and yet we face these risks of a need potentially to disinvest, or certainly to have governance over banks that ensure that they're all in good order. So it's created a lot more uncertainty, and I think investors all want a reward for that uncertainty. So I've given an incredibly quick Cook's tour going back 3,000 years, but I think there are some very obvious near-term challenges to bank economics. You could say that banks are unloved. I think if you were to ask me what's my favorite, it would be European banks still, where the tangible assets to equity ratio is very favorable. You've got very, very cheap banks, and I think they're priced for a much bigger disaster than the one that's actually unfolding. But they also have to deal with this digital acceleration. I think the COVID-19 will accelerate many trends, and they're positive trends on overall, and they'll actually increase productivity in the economy. One of the points Curtis may have been thinking also is that out of this crisis, are we going to have an improvement in productivity, or are we going to have zombie companies? I'm optimistic enough to think we'll have an improvement in productivity, and part of it will be things like an acceleration in digital, in finance, in which costs will fall faster than revenues. It'll be beneficial to the economy, and it'll be beneficial also to ultimately to shareholders in banks. So I apologize if I sometimes do speak quite rapidly and I'm racing through this somewhat, but I'm also aware that we've got very distinguished guests and audience. You may have questions for Curtis and I coming from many directions. So I'll pause there and let's see if we can open for questions.
Well, thank you so much, Rick, for that wonderful presentation. Very enlightening. And we very much appreciate your time. It's As you mentioned, we've come to the point of the presentation where we welcome questions from the audience. I did see one come in just a little bit ago following Curtis's presentation. And it's asking, how do you explain presented recovery signals while COVID-19 cases are returning to higher levels again?
Sure, I can start with that. And I'm interested to hear what Rick says as well. I think two things going on. One is markets are forward looking and they see that the economy is starting to unlock. And as it does so, there's a lot of pent up buying demand and that there's a lot of people who are going back to work. Now that's going to be tempered somewhat as cases pick up, but I think that plays into it. And I think also that the markets are savvy enough to look at the uptick in cases and then the uptick in hospitalizations and deaths. Up until now, deaths and hospitalizations are not rising at the same rate as cases. So that's good. Whether that's younger people, less vulnerable people are being infected, or we're getting better at treated at it. That's probably all part of it. And then the last part is that advances are being made on therapeutics and on a potential vaccine. And again, markets are forward looking and they see 3-4 months ahead. And while things look rough now, if you get those therapeutics and you get that vaccine, we could be back on a very rapid recovery pace in the not too distant future.
I think we're in the chronic phase where we live with the virus in different ways in different parts of the world. I think it looks obvious now that the US has a much higher risk tolerance, or at least the government of the US has a higher risk tolerance than elsewhere. And I think they may tolerate a higher level of infection lasting, and they will do partial shutdowns, as we see in other countries like Germany and elsewhere. And I think investors, it sounds very ghoulish in some ways, they appear willing to accept. I think equities are too expensive, by the way. They're a little bit overvalued. But I think investors are assuming this chronic phase just carries on, but it's not bad enough to shut the economy down.
I agree with that. Thank you both for your answers to that question. Does anyone else in the audience have any questions? Please go ahead and use the raise your hand option to speak directly. In the meantime, we also have another question in the chat group. It says, do you think that COVID will begin a trend of banks leaving high-rise offices in large cities and decentralize their workforces? And then also that there are a lot of implications, if that is the case, to commercial real estate.
Well,
yeah, go ahead, Rick.
Banks have a lot of legacy real estate. They won't be in a rush to dispose of it very quickly, but I do think they'll rethink the footprint. In the long term, people like cities. They've liked cities for thousands of years. I don't think that's going to change. I think that we're in the chronic phase. We'll get through it eventually. I'm not saying we'll return totally to normal, but I think there is a desire to be close. And I think about our business, we're operating really well, but are we training young people well when they're all operating from home? I don't think so. We need to have more proximity. So I'm not sure the change will be quite as dramatic as one might think it could be. Curtis, sorry, I cut you off, and we've got other questions coming as well.
No, I'll just add, I agree with that, and I do, but on the margin, there's going to be some change, right? There's businesses that have found out that they can work as efficiently remotely as they were operating in person, and if they can cut their office space expense they're going to go ahead and do that. So there's going to be some trickle down in the commercial real estate market. We just don't know to what extent that will be. We already know that some businesses have said go remote through the end of the year. Some businesses, I believe Twitter, the US company Twitter, has said that you don't ever have to go back to the office. They're fully remote. So I agree that we're going to mostly go back to the office, but there's going to be some impact on the margin.
Let's see. So we also have another one speaking more towards the security aspects, and given the vulnerability of digital banks and the cyber risks of disruptions, do you think that banking in the future will be a mix? And we touched on this briefly, but a mix of the brick and mortar and the other side being the full online digital banks?
I think it'll be a mix of brick and mortar for a while because of custom and practice, but I think it's going to change. And it'll change quicker than people think. So that's the sort of part, the second part of the question. I don't think people will retain brick and mortar because of cyber risk. I think it'll be for other reasons. But I think the cyber risk point's a very good one. That, I mean, in fact, whether banking is digital or not, cyber risk is an enormous risk that we should all be incredibly vigilant on. And I think regulators are aware of it. We're aware of it as owners of banks, because when we talk to boards of banks, we need to make sure boards have sufficient skill that they understand how to deal with cyber and how to make sure that the management of banks deal well with cyber. I don't think it'll be a reason to hold back from digital, though. To hold on to bricks and mortar.
And do you think that, I'm sorry, Curtis, were you going to jump in? I didn't mean to cut you off.
No, that's right. There's a long-term trend towards going online, and that's likely to accelerate. I will point out that my mom is 75 years old, and she's still trying to go get her passbook stamped at the bank, and they finally said no. They wouldn't stamp it anymore.
So then, do you think that the regulators will relax some of the guidelines pertaining to capital adequacy and LDR ratios?
There has been a little bit of forbearance during the crisis. You know, some of the emergency programs required central banks to, to enable banks to produce more liquidity for customers in money market funds, for example, in the US. And those actions didn't have an implication for the capital ratios of banks. So I think there's a recognition, not that the post-GFC legislation went too far, but that at a point where capital ratios have been very high, during an emergency, you have to make sure you're not being pro-cyclical. And I think there was a mature viewpoint taken across many central banks around the world that they didn't want to add to the problem by being too pro-cyclical. I don't think that's the same as unraveling the guidelines, but I do think they're going to come into question, because certainly in some parts of the world, there was a layering of guidelines on top of one another that probably meant there was an unnecessary amount of capital. And I think that's had a detrimental effect on attracting new capital. It's also had a detrimental effect on liquidity in trading markets in some cases.
Yeah, real quick, the Fed suspended a lot of the capital requirements in March or April, so those went out the window, and then they've done the stress testing, which has been interesting. There's going to be some big hits to the banks in the coming months, but they think that they will withstand the capital. They'll have enough capital to withstand the losses and continue to lend. So that was the good news in the stress test. But it was interesting that they very quickly suspended those capital requirements in the early part of the crisis.
So then, as we look at kind of how the pandemic has affected the global economy, what is the view on an even larger US and global debt level? And how do you see this unwinding or playing out in the future?
I can go ahead and take that. So when you say debt, I assume this is talking about government debt, centralized debt. This is from the chat. So I could talk about this for an hour, 2 hours. I used to do this as part of my job when I was at the Heritage Foundation, was to talk about big deficits and accumulation of national debt, and go around the country, go on television, go do all this stuff. And I gotta say, no one cared. No one cared at all. There was a short blip in 2010 when people cared, and then the some policymakers started to care, and then it went right back, and no one cares. So we had this long-term accumulation of debt. But let me try to share one quick slide that really it gets to the heart of what's going on, which is that yes, that we have COVID-19 has certainly added to the debt, but we were on an unsustainable trajectory beforehand. The orange line is what was going on before, and we were going to hit 100% of GDP in 2031. That's where the orange line. The chart isn't quite right. Excuse me. Go ahead. Sorry, 3-year-old. The black line isn't quite lined up, but it's supposed to hit. It was going to hit the 100% of GDP, which is a rough rule of thumb for problems, in 2031. COVID-19 relief bumps that up, but then it gets there in 2028. So it accelerated the process for about 3 years. But we were on an unsustainable trajectory as it was, and that's driven by entitlement spending here in the U.S. Hopefully, the silver lining is that this makes our federal government, our Congress, much more likely to act in the near term rather than waiting for that crisis to hit. But I'm not all that confident that will happen.
Thank you, Curtis, for that. That was really helpful. There's also a question in here regarding the stock markets, just globally. As we see the numbers continue to rise, I think both of you spoke to this a little bit about the resiliency of not just US citizens, but global citizens as well. So the question is, with the rising cases, why are the stock markets rising? Kind of what is the expectation?
Yeah, well, I think in the long term, the cases do matter, but they're not material enough to affect the labor supply. I mean, to put it maybe more clearly, if GDP is a function of productivity growth and the size of the labor force, if you have a pandemic like the Black Death or the Spanish flu, it wipes out a lot of young people, has an enormous impact on GDP. If you have a pandemic like this one that disrupts the world because of the economic shutdown, but actually kills primarily less active people who are not in the workforce, then the impact's obviously less. So I think what markets are looking for is, are the infections getting to the point where the economy needs to shut down or not in a substantial way? If that is the case, then you've got to be much more concerned about the rebound of both GDP and earnings into 2021. If you think that infections will still rise, but they'll be kept somewhat under control, this kind of chronic model that I pointed out earlier, and you have episodic shutdowns, Californian restaurants for a while, other places, then it may not be bad enough to cause that earnings outlook to be too badly disturbed. But if it gets completely out of control, I mean, that's the nightmare scenario. It gets completely out of control. You have to have a shutdown, a total shutdown again. Market's not pricing that at all. I think the market is a little bit too optimistic, and I think it's pricing now the 2022 earnings, not 21, but 22 earnings. And the path to 22 is quite rocky. I mean, we all agree that in 2022 earnings will be similar to 2019, maybe even slightly higher. But between now and then, you'll have many, many shocks, many bankruptcies and other issues to deal with, and a lot of recapitalization, because there'll be companies that are bearing enormous debts that need to go back to their shareholders, either in private equity or in public equity. And that will be, again, another headwind that equity markets will need to deal with.
So, as we look at the banking sector from a global perspective, can you speak at all to how the GCC and MENA region kind of interacts, the banking sector interacts, and how it will progress moving forward out of this pandemic, both in the region itself and then from a global perspective as well?
Well, I have to be humble on this talk. I'm standing in front of, or sitting in front of, gentlemen and representatives of KBA, KIA, who are much better informed about the banking industry in GCC and MENA. But what I have heard when I've been involved in discussions in the region is that there is a desire at the top, should we say, to accelerate digitization and to some extent to encourage M&A. You've seen this in Saudi Arabia, maybe quite recently. So I think there is a sort of top-down view that the banking sector needs to advance very rapidly, but I think it's hard. And I think when you've had traditional industries of any type, you see this everywhere around the world, and they've got quite a nice business model that works well. It's sometimes hard to have a significant and disruptive change that you bring about yourself. So I think there will be the same changes you see elsewhere, because the issue of being able to reduce operating costs substantially and give better customer outcomes is the same everywhere, but it may be a little bit slower. I don't know whether anyone would volunteer from the KBA or my friends from KIA to comment on that one, but I say I'm humble in the company of those who know a little better.
I could add a little tiny bit on that. Yes, definitely the COVID pandemic has shown that the regulators have managed to get on their toes rather than on their heels in pushing through digitization, pushing through the lessening the paperwork needed for a lot of products and stuff, and they're becoming much more swift in evaluating new things, and that's coming online now with the a lot of wallets are coming downstream in Kuwait, opening bank accounts online without having to have that physical presence and stuff. So yes, we do see this coming because of the COVID-19 epidemic, and costs are coming down. Some painful and some well-deserved. So painful in that with branch closures and shrinking, you do have less employment, and that's not good for the economy as such. But on the flip side, you do have efficiency gains. So it's a two-way street. But that's my 2 cents without elongating the answer. Thank you.
Thank you so much for your comments there. It's very much appreciated. I think that we've reached the point where if you have any final thoughts or closing words, both Rick and Curtis, we would love to hear them. And following that, I will turn it back over to Steve to close us out.
I think I said everything I wanted to say. Thank you.
Yeah, me too. I think we do face a future that has got temporary interruption, but I think some of the things that are being accelerated, I'm very excited about. Certainly in technology and improving productivity, there are many things that normally take a long time to get changed, and we're changing them really rapidly. And it's getting people ready for further change, which can really improve the outcome for both people themselves, citizens and countries, through healthcare systems getting better, but also as investors through efficiency, productivity, and earnings in the out years and in a few years' time, looking much better.
Well, Rick, thank you so much. And to our friends at State Street, we value not only your presentation today, you and Curtis, I think, provided incredible substance, a lot of food for thought, and incredible insights. So really appreciate both of your presentations and your comments and your remarks throughout the Q&A as well. Very insightful. We really do value that. And I do want to give a special note of appreciation again to Mr. Farouk Bastaki and the team at KIA for your support of the bilateral relationship and being with us today. We appreciate you doing that. And I do want to turn to Sheikh Ahmad and give him the last word, our partner in today's webinar at the Kuwait Banking Association, where he serves as vice chairman of that prestigious organization. And we really do value KBA, not only as a partner, again, of the U.S. Kuwait Business Council, but as a friend and an ally in all things in the bilateral economic relationship. So Sheikh Ahmad, I'll turn it to you for the final word.
All I can add is thank you very much, as you said earlier, to the insightful charts and presentations, and I definitely enjoyed the forward-looking thoughts and the a lot of history I definitely enjoyed, which is looks to the past, and I'll definitely be reading much more into that going forward. So thank you again very much. Thank you for Steve for setting this up, and looking forward to more insightful talks. Thank you again.
Well, thank you everybody, and wish you well. We really do appreciate it, and we'll stay in touch with all of you. If anybody has any questions, feel free to reach out to Sarah or myself, or of course, your friends at the KBA. And Mr. Farouk, I see you're unmuted. I do want to give, why don't we give you the opportunity to share any final words?
No, just wanted to thank you all, and it was very useful for me to hear the opinions, Curtis and Rick, and it was very useful for me. Thank you very much. Just wanted to thank you.
Thank you. An honor to have you with us today. Well, thank you, everybody. Wish you well. Be well, stay healthy. And thank you so much for joining us today. And thanks again to Rick and Curtis for the wonderful presentations.
Thank you.
Thank you.
Bye-bye.
Bye, everybody.